Most traders don't fail because they lack knowledge. They fail because every single day they wake up and try to be someone new in the market. New strategy, new indicator, new rules, new hope. And the market doesn't reward hope. It rewards commitment. If you want to survive in trading, you don't need 10 systems. You need one system and the discipline to stay with it when it stops feeling exciting. Let me say this clearly. A trading system is not a set of indicators. It's a decision you make in advance so that your emotions don't get to vote later. When you sit in front of the chart and ask yourself, should I take this trade? You've already lost. A system answers that question before the chart even loads. The professional trader is boring by design. They trade the same market, the same time frame, the same setup, day after day. Not because it's perfect, but because consistency comes from repetition, not creativity. Here's the uncomfortable truth. If you keep changing your system, you are not adapting. You are escaping responsibility. Every loss makes you doubt. Every win makes you reckless. So you rewrite the rules to match your mood. But the market doesn't care how you feel today. A real system does one thing very well. It limits your choices. It tells you when you are allowed to trade and, more importantly, when you are not. And the hardest part is this. You must follow the system even when it loses. Because losses don't mean the system is broken. They mean the probabilities are playing out. Most traders quit right before the edge reveals itself. Not because the system didn't work, but because their patience didn't. Sticking to one system will feel wrong at first. You'll feel slow. You'll feel late. You'll feel like you're missing opportunities. You're not missing opportunities. You're avoiding unnecessary risk. Freedom in trading doesn't come from unlimited choices. It comes from strict rules you trust. And trust is not built in 1 week. It's built when you follow your rules after 3 losses in a row. It's built when you don't trade on days you're emotional. It's built when you show up and do the same thing, even when no one is watching. So build one system, write the rules down, and stop negotiating with yourself, because the moment you stop arguing with the market finally starts making sense. If you want, I can write the next one in a storytelling tone, a hard truth confrontational tone, or a quiet motivational tone. Just tell me which direction you want next. Most traders fail not because they lack knowledge or skill, but because they are constantly chasing new ideas. Every day there is a new indicator, a new strategy, a new guru claiming to have the secret that will finally unlock the markets. And every day, traders abandon the one thing that could have given them real results: commitment. Commitment is the quiet force that separates consistent traders from the rest. Curiosity is loud, flashy, and immediately gratifying. It tempts you to open charts you do not understand, test systems that are unproven, and constantly second-guess what has worked before. Curiosity makes you trade as if you are exploring, but in reality you are gambling. Commitment, on the other hand, is disciplined exploration within a fixed framework. It is doing the same thing over and over, day after day, without needing external validation. Let me illustrate this with a story. There was a trader I once mentored who was brilliant with numbers. He could read price action faster than most people could blink. But every week he switched strategies. 1 week he was a scalper. The next he tried swing trading. Then he tried moving averages. Every system seemed perfect at first glance. But after 3 months, he was down more than he started. Why? Not because he lacked talent, but because he never committed to one path long enough to see its edge. Trading is not about being the smartest person in the room. It's about doing the same thing consistently, even when it feels uncomfortable. Commitment is not exciting. It does not give you immediate satisfaction. Curiosity gives the illusion of progress, but commitment builds real results. Every system has a weakness. Every strategy has losing streaks. If you abandon your plan at the first loss or when the excitement fades, you will never see its true potential. Think about it this way: if a strategy has an edge, it will show itself over time. That edge is statistical. It works not in every trade, but across many trades. To witness this, you need a long-term commitment. It is like planting a tree. You cannot dig it up every day to check if it has grown. You water it, you give it sunlight, you protect it from storms, and in time it grows. Traders who constantly change systems are like gardeners who keep uprooting seeds. Nothing grows that way. So how do you practice commitment in trading? First, pick one market. Don't try to trade stocks, Forex, crypto, and commodities at the same time. Focus on one. It simplifies your analysis and allows you to understand the nuances of that market. Second, pick one time frame. If you are a day trader, maybe it's the 15-minute chart. If you are a swing trader, perhaps the 1 hour or 4 hour chart. Do not switch back and forth. Third, pick one system or setup. This is your framework. Stick to it, document it, and refine it only after enough data shows its strengths and weaknesses. Commitment also means resisting external noise. Social media is full of opinions, trade calls, and analysis that can derail you. But the moment you start listening to everyone else, you lose clarity. A committed trader trades their system, not someone else's advice. They may review insights, but they do not act impulsively. They understand that consistency beats novelty. Let's be clear: commitment does not mean rigidity. It does not mean refusing to adapt when conditions change. The market evolves and your system may need refinement. But this refinement must be deliberate, based on observation and data, not emotion. For example, if your system shows a pattern of consistent losses over 50 trades, you analyze, adjust, and test. You do not abandon it because you are bored or because another trader tweeted a better strategy. Commitment means controlled evolution, not impulsive jumping. Many traders confuse commitment with stubbornness. They think staying with a system blindly is enough. It isn't. Commitment means patience, discipline, and methodical execution. It means following the rules of your system even when losses come, and even when your friends or forums say you're missing out. Every professional trader you admire has made this distinction. They have stuck with their strategy long enough to experience both the highs and lows, learning the rhythm of the market rather than chasing every wave. Let's talk about the psychological aspect. When curiosity drives you, your emotions dictate your trades. Fear of missing out pushes you to enter late. Greed pushes you to overtrade. You try to anticipate every move, but anticipation is rarely profitable. Commitment changes this. It gives your mind structure. You know your rules, your entry, your exit, your risk. The decision-making happens before the trade. During the trade, your job is to follow your system, not negotiate with your emotions. Practical example, imagine you follow a trend following system. The rules are simple: buy when the market is above a moving average, and sell when it is below. You enter trades only on pullbacks that meet specific criteria. You risk 1% per trade. That's it. The system doesn't promise you a win every time, but over 50 trades the probability favors you. If you abandon this system after a few losses because you saw a different setup on social media, you destroy the advantage. Curiosity kills the edge. Commitment preserves it. To solidify this, you must develop rituals that reinforce commitment. Journal your trades, record your reasoning, track your performance. Review it weekly. These practices ensure that your commitment is active, not passive. You see patterns, learn from mistakes, and refine your system with evidence rather than emotion. Commitment is visible in your process, not just your intentions. Finally, understand the long-term impact. Traders who commit build confidence. They understand that losing trades are part of the journey, and that no single trade defines them. They stop chasing excitement and start managing probabilities. They become calm, composed, and rational. This mindset alone separates consistent traders from the majority who panic, jump, and lose. Commitment beats curiosity because curiosity is immediate but shallow. Commitment is delayed but deep. Curiosity promises novelty. Commitment delivers results. You may not feel rewarded every day, but over time, the rewards compound. Stick with your system, your market, and your rules. Be consistent. Be patient. Watch as the edge reveals itself, and in that moment, you understand why commitment matters more than anything else. One of the biggest mistakes traders make is believing that skill or knowledge alone is enough to succeed in the markets. You can read all the books, study every chart pattern, and understand every indicator, but if you cannot manage your emotions, all of that knowledge becomes useless. The human mind is wired to react to fear, greed, excitement, and impatience. Trading without a system is like trying to navigate a storm in a small boat with no compass. You will drift, you will panic, and eventually you will crash. A trading system is not just a set of rules or signals. It is a protective framework. Its primary purpose is to remove emotional decision-making from your trading. Emotions are unpredictable. They make you overtrade, chase losses, enter impulsively, and exit prematurely. A system shields you from these impulses by giving you pre-defined criteria for every action, entry, stop loss, and take profit. When the market moves, you do not guess. You act according to your plan. Let me give you a concrete example. Imagine you are watching the USD chart. You see the price rise sharply, and suddenly your mind starts racing. Maybe I should buy now before it goes higher. Fear of missing out creeps in. You enter late, risking more than your plan allows. The market reverses immediately, and panic sets in. You move your stop loss further away, hoping the market will turn, but it doesn't. You exit at a loss that could have been avoided. This scenario plays out every day for countless traders, and the root cause is emotional trading. Now, let's contrast this with a trader who follows a system. The system says buy only when the market is above a 200 EMA, wait for a pullback to the 20 EMA, risk 1% per trade, and exit at a 1-10, 2 risk-reward ratio. The moment the market shows a potential setup, the trader refers to the system rules. There is no guessing, no fear of missing out, no excitement-driven decision. The trade is either valid or not. If the conditions are not met, the trader does nothing. This removes stress and protects both capital and mental energy. The protective power of a system extends beyond individual trades. Consider a day when the market is volatile, perhaps due to economic news or geopolitical events. An emotional trader might react impulsively, enter trades that do not fit their strategy, and end up compounding losses. A system-following trader has rules that define when not to trade. The system becomes a shield during these high-risk periods, preventing decisions that the trader's emotions might otherwise dictate. Emotions can also distort perception. When you experience a string of winning trades, overconfidence may creep in. You start to believe you can predict the market with your instincts rather than relying on rules. You take larger positions, stretch stop losses, or skip steps in your plan. Conversely, a string of losses can trigger despair and second guessing. You may abandon your strategy, chase the market, or refuse to take any trades paralyzed by fear. A system mitigates these extremes by providing a structured path that remains constant regardless of wins or losses. To understand why a system is essential, it helps to consider the psychology of probability. Trading is not about winning every trade, it is about executing an edge over many trades. Without a system, emotions interfere with this process. You might abandon your plan after one loss or double your position after one win, thinking you are sure of the next move. Probability does not care about your feelings. It only rewards consistent application of rules. A system ensures consistency, which allows probability to work in your favor. Let me share another story. A trader I worked with had excellent technical knowledge. He could spot patterns with precision. Yet he had no system. One day, after a profitable streak, he ignored his usual risk controls and entered multiple trades impulsively. The market turned sharply, and he lost half of his account in a single session. The loss was devastating, not because the market was unpredictable, but because he let emotions dictate his actions. This could have been prevented with a simple, disciplined system that defined risk and entry conditions. A system also enforces discipline through repetition. When you execute trades according to pre-defined rules, you are training your mind to detach from emotional impulses. Over time, this creates a mindset of calm observation rather than reactive behavior. You learn to trust the process, not the momentary highs or lows. This is why professional traders appear composed even during volatile sessions. They are not immune to emotions, they simply operate within a framework that neutralizes emotional influence. One practical method to protect against emotions is journaling. Every trade should include the reason for entry, the system criteria met, stop loss, target, and outcome. By reviewing these logs, you see patterns of behavior, identify mistakes, and reinforce adherence to your system. Journaling transforms emotions into data. When you see that a trade failed because rules were broken, not because the market betrayed you, it strengthens your trust in the system. Another critical element is risk management. Your system should define not only entry and exit points but also position sizing. Risking more than your rules allow opens the door for emotions to dominate. Fear